Greetings, ladies and gentlemen. A warm welcome to our fourth installment of the ACES webinar series titled 10xing Early Stage Investing in Africa. My name is Orisia Nyawade, and I am the head of marketing and communications here at ACES. I hope you guys are excited to listen to the fantastic speaker lineup that we have today. If you don't know, this is our 10th anniversary, and we are very excited for our upcoming summit that will be held in Cape Town from November 30th to December 1st. So some of the exciting activities that we've been doing throughout the year to just keep us engaged as we lead up to the summit have been our monthly newsletter. If you are a part of that community, you should have received the latest one on August 1st. If not, we will be pinning the link so that you can please join us there, because we have various announcements of what is happening at ACES. Also, we've been doing the webinar series, so this session is recorded, and in case you missed it or you have to leave early, you can go and catch the replay on our YouTube channel. And then the last and final thing that we'll be doing as ACES is hosting the in-person meetups. So this year we have an awesome goal of hosting 10 international meetups. That will be on September 7th, 2023. And then we also have a goal of hosting 50 African city meetups. So far we're on 27. If you would like to know which ones are signed up, again, please do follow us. And I hope that you can register and sign up and attend those to continue networking with your fellow investors. So today we have our lovely moderator, Mr. Thomas Van Halen of VC 4A. He is the impact. Oh my God. He's an impact-oriented investment professional with over 12 years of experience. So he has extensive networks in startup ecosystems and in emerging markets. So prior to joining VC4A, Thomas had his own company where he conducted business research in Europe, Asia, and Africa. Thomas, over to you, and a warm welcome to everyone.
Thank you very much, Orisia, and what a wonderful introduction. I hope I can come close to manage these high expectations. But welcome to all of you to indeed another webinar in this special series of webinars leading up to the main summit in Cape Town, as mentioned by Orisia, November 30, December 1. All around the theme of 10xing early stage investing in Africa. And what we will be discussing today in specific is the journey from being an entrepreneur to an angel investor to a VC. And that's where we are super excited to have two very distinguished guests. Let me first quickly introduce you Kevin Simmons, one of the GPs at Lofty Capital Management, also started as an angel himself, and through the Lofty Inc. Fund made over 86 investments in 19 countries. So welcome to the stage, Kevin. Wonderful to have you. Next up is Sewu-Steve Taiwa from Jaza Risk Ventures. Fun fact is actually that we both share we are both alumni of Maastricht University. So some shared history there. Also, Sewu-Steve started as an angel, and with more than 20 years of experience in impact investing and private equity. He is now also busy raising for his own fund, Jasa Risk Ventures, and also would love to bring you up on the stage. Welcome, Sewu-Steve. So to kick off today's the conversation, Kevin, would be great to hear a little bit more about yourself, and maybe also for the crowd to better understand where you're calling in from today, actually.
Thanks very much, Thomas. Real pleasure to be here with everyone. I'm actually calling in from Barbados at the moment. I'm stepping out of a business forum that's going on as we speak. I'm about to go moderate a panel. It's a Barbados Rwanda investment mission. Yeah, so that's where I'm calling in from. Thanks for putting that out there. Yeah, just a quick introduction. So I'm Kevin Simmons. I'm a partner with Lofty Inc. Capital Management. I'm not sure who we have in the audience. So Lofty Inc. is kind of one of the firms that's been investing in early stage technology ventures in Africa for some time. We kind of started that effort somewhere 2009-10. We trace our roots back to first kind of our incubator work that still continues with the Innovation Hub. This is probably before there was much of a tech scene in Nigeria. And then that's evolved into other arms. And now we're raising our fourth fund on the VC side. So I'm a partner with our fourth fund. One of the entities that we kind of started, maybe 10 years ago investing was the Afripreneur Angel Group, which came out of some earlier angel investment efforts called the Lofty Angel Network, which became the Lagos Angel Network, which is now ABAN. So again, in 2012 or 13, we started writing checks to some of the companies and others that we were incubating through Innovation Hub. I'm kind of jumping all over, but in some regards, we've sometimes considered one of the more active early stage investors. I don't know if that's a good thing or a bad thing, because activity isn't necessarily success, but we've had a lot of experience, learning all that it is to be an angel. And then obviously now we do it more professionally as venture applicators. Probably stop there, maybe Thomas, and maybe throughout a little bit of background about myself. I'm an engineer by background, spent most of my early career back then. I'm going to date myself here, but I kind of started out liking technology back in the dot-com days as a grad student at Stanford when they were actually building all these companies that I didn't know would go on to be really big things. I always tell the story that I was on campus one day walking around and someone shoved a shirt in my hand. And I was like, what's this Googler thing? It's very, very early. This is, before, let's just say before 2000. Let's not add much of a date. And I wish now that I wish I'd taken $20 in my pocket and give it to the guy to buy some shares in Google at the time. It would have been a much different story. And I wouldn't be calling in from here. I'd be probably calling in from my own island. No, I'm just teasing. Anyway, so did that as a career for a while, and then met Idris in business school. Idris is the founder of Lofty Inc. Capital, and we started building our first startup together, which let's just say we learned a lot from, lessons in failure. And I've continued to be an operator and an investor. So I've been building multiple ventures since then, and actually just exited one in the UK last week. So I tend to wear both hats, both as an investor and a builder. Not so sure I'm good at either of them, but apart from that, probably just spend a lot of my time advising early stage startups through different programs, mentor for Techstars and other things. So I'll wrap that there in the interest of time and pass it back to you, Thomas.
Thanks very much, Kevin. And I'm pretty sure lots to share today. Also, just a quick shout out to the audience. Many questions there is space to ask your questions, so please drop them in the chat. Also great to hear a little bit more about yourself, so feel free to do a quick intro because as these sessions are very much, of course, about the speakers, it's as much about the audience, especially since there's no textbooks around VC or early stage investing in emerging markets. So let's use these sessions to learn from each other, and that includes yourself. So please make use of the chat for that. Over to you, Sewu-Steve. Just a little bit more about yourself and where you're coming from.
It's not as fancy as Kevin, but I'm calling from Accra, Ghana, where I spend half of my time between Ghana and Kenya, so Accra and Nairobi. Originally from Ghana. I always say that I'm Ghanaian and French, so the French part always surprises people. One of those ones. Worked more than 25 years now across sales and trading of equity, fixed income, and credit derivatives for a number of years. Worked after that in 6 years in consulting, strategy, operation, and technology consulting, mostly in financial services, and then decided to shift careers and worked in private equity and venture capital funds, fund of funds for the European Investment Fund and the bank in Luxembourg. It's a 25 billion euro fund of fund plus other asset classes. And then decided to come back home, and basically been spending my life across Ghana and Kenya mostly, but over the last 7 years I've been back, essentially traveled to work in more than 30 countries in sub-Saharan Africa. If I include North Africa, Egypt, Tunisia, Morocco, that's about 40 of those. And essentially, I started totally as an angel in a very funny way. We'll tell you about it more. So today I lead Jazari Ventures, which is a health tech, medtech, and biotech fund. We're targeting 5 million for the Pioneers Fund, but next year going to start discussing a much bigger $50 million one. And essentially, we want to provide better healthcare to the continent, and by making those investments in digital health, medical devices, and biotech or tech bio companies on the continent. So happy to tell you more, but essentially I transitioned from an angel investor at Asime Ventures to Jazari Ventures, which is my health tech fund. Thank you.
Thanks, Sewu-Steve. First question, actually to you, Kevin. So you just mentioned you had your first startup together with Idris. Looking back at that first pitch deck, actually that you've created back then, and you would receive that on your desk right now, would you actually have invested? Yes or no?
That's a fat no. That's a hard pass. That's a yeah. And it's not just that one. To be honest with you, I guess over the 10 years, so I've been angel investing both in Africa and in the US. We started a syndicate out of business school. That's a group now that's probably the second largest in Texas and the UK. I'm not sure I would invest in many of the early businesses that I invested in 10 years ago. So I like to think I've learned a few things. And one of the things many of the things I've learned is, that was a pretty weak business we were trying to build at the time. So I wouldn't invest in it today, no.
And what would be your advice actually to you as an entrepreneur back then to improve your deck, to make it more, let's say, investment ready or?
So, and look, I mean, that's we could probably speak for an entire hour on all the tips that I might pass on to founders and that I do pass on, whether it's wasting all my time every weekend still in Clubhouse or not. But some of the things that I can tell you, if I'm thinking about that first business, what we did not do or wasn't clear then, which I still think applies today. So some of the tips would be, I think simplicity is really important. I think, I'll be honest, and I was the architect of that whole business and deck to some extent. If you can't tell it in a simple story, it's probably too complex a business or an iteration of that business, right? So there is value in simplicity, in clarity. You should be able to, and it sounds cliche, but you really should be able to describe how your business makes money in a very few sentences, okay? If each time you feel and you hear that you're trying to have someone spend an hour to understand your business or 30 minutes, and then you're trying to educate them. Just think about that times a million. You're going to be doing that to every single customer, and that's not a way you want to. That's not how you want to grow a business. So a clear, simple way to make money is one of the things. I could go through other tips. I would say one of the things that I struggle with in the decks that I see today, and I'm probably moving the question, is I get a little bit frustrated. I look for clear business models, and I just don't mean a title, oh, B2C. That's not a business model, right? But how are you going to deliver the specific value that you spent the first 3 slides talking about? Here's the problem, here's a solution, here's why people want to. Because, you know, I see a lot of that done very well, and then there's a departure into all this other stuff. But that's not the business that solves this problem over and over for people who are willing to pay for it. So, and then I get to where I'm always like, you know, if a founder doesn't understand their business model, to me, they don't understand their business. We've learned that painfully. You know, we sometimes say at Lofty, we all have LLMs, you know, so we've learned by losing money. So that's our degree from investing. And maybe that's what qualifies me to say that, yeah, I could go on, but those are just one of the tips. So very simple, clear communication of the business model. So how do you make money? I ask that question a lot. I say to people, you know, I ask them to fill out a sentence, you know, I make more money if, or I make more money when, right? And if they should be able to say when what happens, because that points to all the big parts of your business, right? So whether it's like, I don't know, on an e-commerce site, you know, I make more money if more people, you know, spend more time or buy more per each time they're on my site, etc. Because then you start to understand conversion and churn and traffic and all this stuff. So, yeah, sorry about that. Yeah, I'll just stop there. Those are, we could go on at length about things in decks, but generally, I'm a big fan of a clear, simple business and a business model that's clear, and I understand you know how to make it work. And I'll stop and see you. Seu's probably going to improve on that answer by 10. So, yeah, come and save me, Seu.
Yeah, sort of a similar the question to you then. Like looking at the first 1 or 2 investments you've made as an angel, would you have invested? I mean, of course, there's much more knowledge and information now, but would you have invested still?
Funny enough, the first investment I made, it wasn't based on a deck. Literally, I didn't see any deck or whatever. Like I put £10,000 into a company in UK. It's a woman-led, actually, first one. Black Ghanaian lady in London doing. It wasn't tech. It was more of an SME. Basically, it was called Chop Pot. Essentially, the idea was to do African food that are affordable, accessible, and also available for young Africans in London initially, so that they can, instead of going to take away a pizza or a falafel, whatever, they go and take away African food. So there was jollof, stew, etc., etc. So I didn't need a deck. I could see the business, right? So I invested. Oh my, what a mistake. No, I'm joking, but it wasn't a mistake. I got my money back, you know, with a lot of ups and downs for about 5.5 years. And so in hindsight, that's what hooked me into angel investing. I started angel investing totally by interest in one particular lady and the business she was doing in a food business that I deeply understood, and I saw the need. I didn't need a calculation or, oh, what's the market size, what's the appetite, etc., etc. Like, I didn't need that. And that was, 2007, 2008. And so that was the first one. The other ones, effectively, you know, I had pitch decks, etc. But it seems to me that fundamentally, even if I've seen pitch deck, business model, etc., I say for me as an angel, 80% of my decision is based on the founders. When I meet the founders, I understand, I ask them questions about themselves. Why are they doing that? And through my conversation with them, I will understand a couple of things. One, they understand the product or service they want to offer. They understand the market potential. They have a pretty clear direction as to how they can make it work. But then, you know, execution is going to be as I said, British people say the proof is in the pudding, right? So once you start doing it, you hit the road, then you understand that, okay, it's not going to work, it's going to work, and how do I pivot, etc. So I would say, for me, decks are just a recipient to say, who am I? What do I see? How I'm going to go about whatever I see, and I'm the right person to do it. And that really tells me it's just like a business card for me. A pitch deck is a business card. This is my business card. This is what I'm going to do. Like the typical elevator pitch you see in a elevator, typical 2 minutes. Like, what does it look like? And funny enough, there's the statistics around pitch decks. I don't know if everybody knows, but most people who look at pitch decks spend less than 3 minutes on a pitch deck. That means that your slides have to be crystal clear. And as Kevin says, simple. We need to read through very quickly, okay, how does it work? Who is it? What's the size of the market? And have a feeling that the team that you're putting out there in the deck is actually the right one to execute. And that's pretty much it. Yeah. And so my experience of investing started off very totally unusually with that first investment. And then I invested in EdTech and other ones. And again, I would say my first 3, 4 maybe investments were not based on the pitch deck. People I met, they pitched to me verbally, and then they sent the pitch deck after that.
Yeah, and after these first investments as an angel, actually, what made you or what motivated you to now also start your own fund? Actually,
I think so. If I stick at the angel side, the fund is a whole different animal. But as an angel investor, it's really about meeting people, understanding the businesses, and as you go along, you realize that it's always better to invest as a group because you don't know it all across all sectors. So as soon as you can get along with more senior or more experienced angel investors or angel groups, as Kevin and Idris and others did, it's very, very much better for you because you get to leverage other people's brains and experience and really get that out. And I mean, the motivation to start an institutional fund, I used to run one in between the angel and this healthcare one. And actually, for a long time, I did not want to go into an institutional fund because my job for 6 years was to actually be an investor in funds. So at the European Investment Fund, I spent 6 years reviewing 200 plus per year VC PE funds in Europe. I know the challenges, the hardcore things that are needed to get to a fund, an institutional fund. And to be honest, I just wanted to set up a holding company, not do all these structures, etc., because I find it too cumbersome. But I will talk more and then about the reasons why I ultimately did.
And also for you, Kevin, like, how do you see your activities changed, turning from angel to GP fund manager?
It's a great question because it's something that I'm personally going through now, and Lofty has kind of gone through quite recently, where, as we said, we started as angels, and we still do a lot of angel activity with the angel group, but well, look, I think there's a change that's happened where, as an angel, I get to make an independent decision, and the only risk appetite that matters, or the only fiduciary responsibility I have, is to myself, right? And that makes it sometimes much easier to make a decision. I'm not saying right, but now as a GP, first, we're going through the process of getting other people's money is not easy. Like Sewu said, I spend a lot of time right now talking to DFIs and everyone else and going through that entire song and dance. Sometimes, I actually now have more sympathy for founders raising than before, and I've raised as a founder, but sometimes they won't realize that we also on the VC side have to pitch and raise funds and the same stuff that we're going to talk about. But as a GP, and now we're kind of really looking to institutionalize all that we've learned to have better practices around not just how we invest, but how we do the post-investment work. Because honestly, to write the check is just the first step. But to try to help the founders and the companies get to where they have a really successful outcome, and then you can return capital to your LPs, there's a whole lot of work that I think as an angel you don't necessarily think about, even though you want that outcome. On the VC side, you have to think about, and so you have to do a lot of the work. You have to think a lot about governance these days. You have to think about risk. You're looking at a whole portfolio, how you're going to handle risk, and whether that's currency risk or whatever. So I would say I'm enjoying it because I'm learning more personally. I think we've probably all in the firm have become better students than we did when we were first angel investing, where we have to go and learn a lot, having to learn how to build a fund, having to learn how to build a portfolio, how to model it. And obviously there are many GPs that come in from the backgrounds that they'll know that already. But for us, we tend to have a background more, we were builders and then angel investors. And so there's a steep learning curve. So that's one of the big differences on the VC side. It's a whole industry, a whole dynamic, and a different set of economics than on the angel side. So I don't know, maybe there's just some that jump out. I think.
I think I heard already the pink elephant in the room, which is fundraising. So not only entrepreneurs are fundraising, but as a GP or a general partner, to use the full word, is one of the big challenges. Keeping in mind current trends, what's the fundraising climate these days for you guys?
Well, I'll just jump in. So I'll tell you this. I'll give maybe. So our third fund, just give a data point. We raised in 2021, and realistically, maybe it was 9 months, maybe it was 6 months, right? It was a smaller fund, of course, than what we're doing now by a margin, but we were oversubscribed by about 40%. We had some institutional range of family offices and other high net worths, but we were able to open and close that fund very quickly. I almost want to say 6 months, but maybe it was a bit more than that when all was said and done. That's not the environment right now today. and part of that is obviously, for us personally, and I don't know who's on the call, so I'll be a little bit, we weren't raising from DFIs then. Now, because of the size of our fund, we've included DFIs, and it's a much different process. But to answer your question about the climate, the environment has shifted a bit. Generally, I think that's a good thing. I think capital was probably, in some ways, I say this in some regards, was too available in 21. And I say that more from a pricing perspective, even within startups, right? There's and look, if you look globally, no, there was not. It's easy to say, oh, there was too much money. There was not enough money flowing into Africa. There still isn't. So I want to say that up front. However, relative to 17, 18, 19, 20, there was more investment coming in. And I think at the expense sometimes of more discipline, both on the investor side and on the founder side. I have many stories about, businesses that we were seeing that were pre-launch, pre-revenue, pre-everything, that were commanding or asking for valuations and size of raises that, to be honest, were probably much closer to a Series A. And this is for like a pre-seed company. That was happening in 2021. So, as I said, I think somewhat it was easier to raise 2 years ago than it is right now. So it's taking longer to raise. But generally, it's still possible to raise if you have a strong thesis, strong track record. And just like I said, the startups, because they always come to me, it's like, should we raise now or not? I said, well, do you need the capital now? Yes, then you should raise. And are you a good team building a good business? And so the better businesses, the better teams shouldn't be scared of raising in this climate. And I think the same applies on the fund side. Yeah. So,
but how are you keeping the discipline, especially during times when, let's say, money is more available?
Well, I'd love to sit here and say that we didn't chase some deals that we shouldn't have, and And since then now we're seeing down rounds and we're seeing repricing and everything. I'd like to think we have very strict like entry points. Like we do like to come in below a certain valuation, etc., for good reason. But obviously because this game is also about exits, and there are not enough exits in our ecosystem. So we did probably. There was FOMO everywhere. It was hard to not get caught up in some of it, and you had the likes of whether it was Tiger, Global, or whatever, throwing money into the ecosystem. It did inflate prices. I think it's fair enough to say that. We tried to stay disciplined, and we did say no to some things, but we probably joined some rounds that maybe in hindsight, if we were happening this year, we probably wouldn't have joined on price alone, because you're investing in a number of things, right? Definitely early stage investing is the founder. That's the largest bit. But you're also, so it's them and the team, but you're also looking at the performance and potential of the business, right? How has it been performing? Although early stage is not much behind, but what's the potential of it? Is it a large market, big problem, whatever? But then you're also looking at the deal itself. The deal is another factor, the pricing of it. And sometimes you could have a really good founder with a business that looks like it has a lot of potential, and it's just, for us, just the prices doesn't match. It's just too far gone, So I think you have to look at all three things. And yeah, so we try to stay disciplined even on price. Can't say we've always succeeded. I've got some horror stories.
Always love to hear the horror stories from you, Kevin. But Sewu, also for you, how do you actually see this downtime have an impact of unlocking more capital from, let's say, the local high net worth individuals, or even institutional investors?
So I think I'm going to take a two-pronged approach to this answer. My experience on the continent to date has been that generally people that have quote unquote money, capital to invest on the continent, tend to be asset rich and cash poor. I repeat, asset rich, cash poor. And this was a huge realization for me, essentially, when I really started to dig into the potential high net worth individuals and entities on the continent. Asset rich, cash poor. That means that whoever you're going to ask for money, take a lead time of 6 months to a year before the person can actually even have cash to disburse or to invest, number one. Number two, my experience so far has also been that, and especially unfortunately in the last, I would say 12 months, people who on the continent who have committed have defaulted on their commitments, both at the investors level, but also on the startup level. That creates a lot of uncertainties and problems for both startups and funds like us. And so that environment, for me, at least, except maybe for Egypt, Nigeria, and South Africa, even South Africa, it's not always the case. That's been quite a tough wake-up call. Okay. So now, beyond that, finding the pools of capital to raise, both for startups and fund managers like ourselves, today is a much tougher call. Basically, you need, and Kevin said it, your business fundamentals need to be robust. You need to demonstrate strong traction. And the new mantra is profitability, unit economics, etc., which wasn't the case before, but it should have been. And just like Kevin, I had to say no thanks, or maybe later, to a lot of investments over 2022 and even 2021. I always found that valuation were through the roof. I even had to say that anything that is fintech in Nigeria, I'm not touching. Overvalued by 30 to 50%. That was my mantra, personal mantra. I was like, fintech in Nigeria, I'm not touching. Too high, right? And so essentially, I think things have come down and people are really going back to the fundamentals. Now, in terms of fundraising strategy, I must say for us at Jazari Ventures, we have a particular strategy, which is a thematic one, healthcare in Africa. So imagine LPs, so investors out of Africa, where today I think the base rate in dollar in the US is 5.5% from the Fed Reserve. So that means that if you don't tell an investor, wherever literally they are from, really today, that you're going to generate much more than 5.5% on the dollar on an annualized basis, they're not going to look at you. So the environment has changed. You know, when it was zero interest from the Federal Reserve in the US, everybody was looking for high yield. High yield then was 7%, 8%. Now that the base rate in the US is 5.5%, you essentially need to promise people double that or triple that for them to consider you. So any fund today that is not demonstrating or targeting 3 to 5 times money back will not be considered. And so the same applies for a lot of entrepreneurs. If you can't demonstrate that within 5 to 7 years, you can return investor capital or give them an exit that gives them, for the risk taken, somewhere around 30 to 40% IRR, or I would say 3 to 4 times money, they're not going to consider it. So sometimes entrepreneurs need to put themselves in the shoes of an investor. And the same thing for a GP. You need to kind of really understand your fund, your investor base. And it's tough because a lot of people, for me at least, consider healthcare as, oh, it's developmental, etc. It is, but essentially, just with ventures, we want to demonstrate that you can make money and achieve impact.
Yeah, because Sewu-Steve, so your typical LP, how does he or she look like?
That's a tough question. And I'm sure Kevin is laughing. He knows it. It's a difficult question because, you know, looking for LPs is like looking for a needle in a haystack.
Okay, right? maybe change the question a little bit. Would you rather raise from one DFI or from 10 smaller LPs?
I see your question, but it depends on your strategy, right? Basically, your fund size is your strategy. So I'll give you an example. And I mean, this is something we're considering for next year, 2025, probably. Should we manage to close our $5 million fund, $5 million is one investment from any of the DFI, one investment. So that means that if you're raising a $5 million fund, the DFIs won't consider you. It's like, no way. So you need to look at high net worth individuals, family foundations, etc., which are not many on the continent. That means that default places are individuals and family offices in the US, Canada, Europe, Asia, that are able to put ticket sizes of 100 to 500K or a million even into a $5 million fund. But a 50 or $100 million fund, you can get ticket sizes of 10, 15, 20 million by one investor. Today, because we're raising a smaller fund, I think, you know, we're speaking to smaller people, but they're very difficult to find, to be honest. For me, I come from a DFI world. It's easier for me to go and see the DFIs to tell them, look, I'm raising a $100 million fund, speak to IFC, World Bank, IFC is World Bank, AFDB, BII, all the big guys who can drop 15 million, 10 million, 5 million into a $100 million fund, then little. And that's the biggest challenge today.
Yeah. Thank you. And I'm gonna ask a similar question to you, Kevin, but not before learning from that quote from you, Sewu-Steve, about investors being asset-rich, cash-poor. That's where we do have a special discount for all the investors in the room today. Where we would love to see you in Cape Town. And with this special discount of ACES webinar minus 100, you will receive a $100 discount on the summit ticket. So this is for all the asset rich cash poor people in the room. If you're not like that, of course you can always buy the full ticket. But nevertheless, we very much hope to see you in Cape Town, but also to hear from more investors and learn from each other, which is for us the most important thing. So Kevin, over to you, or back to you actually. So also that question, like, would you rather raise from one DFI or 10 smaller LPs?
So in case any of the DFIs that we're speaking with are listening, I definitely want to raise from you. No, but no, exactly like she said. A lot of it is driven by your strategy, and so it's at the size that we are trying to raise right now. It'd probably be difficult to do that from just high net worth, because they said the makeup of the high net worth spectrum across the continent is probably still restrictive. Not that you have to raise from the continent. Obviously we're raising from other places, although we do have a real commitment. We're really attempting this time to have more African capital be present in this particular fund, for a lot of reasons. I mean, one of the things you mentioned is, look, just like a founder, right? You're going to be raising within the macroeconomic context that you are in, right? And so, like before, when you had, as you said, low interest rates, you were a somewhat attractive place to park capital for some folks. For overseas investors, for example, when that changes, like it's changed, some of the overseas investors don't need to take emerging market risk or, distant market risk to get the same return. And so they will stay at home, and so we are looking to broaden our LP base by doing so. And as a result, if you're limited in the high net worth or the family offices you can raise from, and just to be clear, the size of fund is also driven by the work that you want to do, right? What is it that the stage that you're investing in, what is it that you believe those companies need, and how much capital do you need to take enough of an ownership stake in that business that if that business does exit, and there's a lot of ifs in our ecosystem around, the exits, then, so it's kind of multiple variables that come together to create your fund strategy. So, but to answer the question, look, raising from DFIs is not easy. I think I'm gonna take the over under here and say, the benefit of DFIs, however, is that they're very committed quite often to their particular development goal and aim. And if they support you, there's a belief that they'll continue to support you. So if you're thinking about it from a firm perspective, not just a single fund perspective, you want to have an investor partner that follows you with subsequent funds and makes it easier to raise subsequent funds. If, however, it's just a single fund that you're building, then I would probably I'd rather talk to 10 commercial investors rather than one development investor. But again, the pros and cons of each. I hope I didn't answer that.
But still, you owe us that horror story, Kevin. And of course, without mentioning any names, but I know there is some aspiring fund managers here in the audience today. And especially you also made this point about you need to broaden your LP base. But how, as a GP, are you, or can you actually manage this? Because of course, raising is one aspect of it, but then you also need to have to actually do the work together. So how some tips, tricks, or the horror stories you can maybe share with us.
Okay, so there are two kind of quick questions in there. So one is I'm going to take, and I think within the context of the broader topic of how do we 10x early stage investing in Africa, right? So one of them, like I said, is broaden the LP base, getting more people willing to invest in Africa. One, so there's an element there are investors that are already investing here. There are LPs that are backing funds. There are the DFIs, but there are others who, for whatever reason, are driven to deploy capital here, whether that's for impact reasons, whether that's for commercial reasons, because there are commercial returns to be had, whether that's for development reasons, there are some of those. But you're not going to 10x early stage investing in Africa if you don't broaden the LP base. You're also not going to do it if you don't broaden the founder base. You're going to need more people building more tech, building better businesses. You're going to need more people investing. So this whole 10x goal is going to need all. So I answered a bit about any tips and tricks. How do you expand the pool of investors? Painfully and slowly. No, look, I think you have to be creative and be able to answer the why Africa conversation, right? So what is happening in Africa that from a macroeconomic perspective means that you have high conviction that the future is going to be better than the present. I mean, as investors, that's what you're trying to do, right? What things are going to look like in 5 years and 10 years. And look, and those are strong for Africa, right? Africa has the fastest growing, youngest population, rapidly increasing rate of internet adoption. All these different things are all in a fairly bullish trend long term. I mean, if you sit and focus on a particular market and devaluation and certain specific risk, yes, you'll have those, and that can be very scary. But if you think about it writ large, if you step back and say it's a continent of 1.3 billion young people who now have the ability to solve some very chronic, large problems using technology, and the ability, meaning both the talent, the know-how, and so on, it's still a fairly attractive story. So one thing is to get people that weren't interested in Africa, they've got to buy into that story first. And then you go through all the other elements of, you have to convince investors that you can allocate capital effectively and give them a return. You can do risk management well. You can, you're aware of both governance and also impact, because whether or not you're an impact fund or not, you have a responsibility in our ecosystem. You're going to be doing impactful work. And so there's a number of different things to get people in. But look, what are we seeing from trips? We're seeing a lot of people, for example, there's interest from the GCC, so the Middle East, that wasn't there maybe 5-6 years ago. There's an interest in that capital flowing to Africa because they see their businesses looking to get into Africa and vice versa, right? There's a lot of similarity between the problem sets that you might have in large markets that have fairly informal economies, et cetera. Very similar, whether it's Pakistan, Bangladesh, Middle East, et cetera. For example, we're seeing Japanese corporates. That sounds crazy, but there's a lot of interest from Japanese corporates to become investors, both direct or through VC funds and maybe even PE. So there are pockets globally where that conversation can be had that broadens the base of investors in Africa. It's not everywhere, but yeah. But that's so. Any tips and tricks? I mean, I don't know if there are any tips yet. I'm still going through it. But similar to a startup, like I'm going to apply the same rules that I apply to startups for us. Like, so what Sewu was saying, you have to be competitive. You have to have a business that is investable, which means, that it's capable of, so even as a fund, capable of returning what you're promising to return. So whether that's 3x, 4x, I probably would stay away from a 5x assertion because I'm like, and so you have to convince, you just can't say it. You have to show, what is the pipeline you're looking at? What are the companies in the right sectors and markets that can grow to be 200, 500 million, 700 million, et cetera. And is the data there to support that? We don't really have that many billion-dollar companies on the continent. I mean, we've been fortunate to be involved in a number of the unicorns, but beyond that, there's still not that many. You look at India, you have what now, 100 unicorns, and Israel has way more than most people per capita. So are those conditions there? And then can you convince an investor that you can either help create those conditions, or you can recognize those conditions and get access to those deals and so on? So just like a startup, I say the founder to a fund, the conversation is the same. You have to convince that you can execute the business that you're saying you can execute, et cetera.
Yeah. And I think this also touches the question by Bob Davis about the M&A market, and also his question about what changes are needed to increase the number of potential acquirers of growing startups and potentially also 10x your investment. Sewu, maybe that's something you can help answer.
Sure. So if I understand well, the question is exit market in Africa, right? Yeah. So that's been a contentious issue of mine for a long time. One, we don't have robust IPO markets except for South Africa, to some extent Egypt. And there's been work done by the African Development Bank and other institutions to support that aspect, to have more IPO and more capital markets that allows SMEs to essentially get liquidity and raise capital institutionally. So the work has been done. I can mention so many other things. That's number one. Number two, generally speaking, I would say 60% of exits or even 70% of exits on the continent are trade sales or strategics, right? And so that means that the companies you're building need to be in a stage where they've grown enough to be of interest to larger corporations to acquire, right? And funny enough, most often than not, those larger corporations are usually international ones, right? And so the key thing there is to understand what the international requirements are, okay? And really prepare the bride for those kind of exit. The other thing I would say is that, and hopefully with the AFTA, the Africa Free Continental Trade Agreement, more and more regional champions would take the mantle and expand to other regions, right? Except for, I would say, Nigerian and South African companies out of Africa expanding into Africa, the rest of Africa, I would say, and now they're actually retrenching. We haven't seen substantial east-west, for instance, or more west to east expansions of banking, telecom, conglomerates, right? And this needs to be driven more to support local companies to essentially, follow suit and be a target for acquisition, right? So on this exit market, to be honest, one thing I would also see that worked in many other markets that actually could start working on the continent is, because we've gone through a very difficult period, companies and founders need to understand that it's better to go together, to go far together than fast alone. And so there's a bit too much ego in a lot of the founders that we have on the continent. They need to understand that they need to put their ego on the side and look at the bigger picture. And hopefully we can expect more buy and build. I'll explain. You can have different investors investing in different companies in the similar sector, let's say Nigeria, Kenya, South Africa, and Egypt, the big four. Founders in those companies need to understand that actually, instead of trying to expand individually and raise capital to expand to those countries, check in the country if they're not interested in target to merge to become stronger, right? So you build. And a number of people have been doing that in PE, in private equity, but also in VC in other markets. And what I'm hoping to see is more tech founders put their ego on the side and accept to merge with other companies to create a bigger platform for everybody, right? And this is pretty standard in private equity. You create a holding company in a decent jurisdiction, and then you be putting together different companies in a value chain to integrate them either vertically upfront or backward integration. And this will create African champions, then after can start expanding to other regions, Latin America, and Kevin was saying Bangladesh, Pakistan, Cambodia, etc. I mean, this is possible, except that we need to change our mindset as to say, let's do more partnerships, going further together than fast alone.
Thank you very much for that. I see one more question from Carl in the Q&A, which is around: do you think that these conditions produce more mature companies exiting, and a focus on more operational excellence and less hype compared to other ecosystems? Any takers here?
Oh, obviously. Okay, go. Okay.
No, go ahead, Sewu. You go.
No, obviously. I mean, and Kevin mentioned it earlier. we are seeing much more real companies. And I mean, we've seen so many cases both in Nigeria and Kenya, for instance, where companies were raised capital on hype and very quickly were, like after a year, you were seeing things being closed, people being fired, or even scandals. Like people raise a lot of money, misused capital during profligacy time, etc. And this came back to bite them, right? I don't want to mention names of companies, but if you Google that, you find it, right? So I think we've come back to fundamentals. And the problem with market, and I have to say I've been through 2001, 2008 now, the pendulum switches way too backwards as well. So the pendulum swung all the way to high, very high, very, very high valuation for something that didn't have any legs, to the other side where good companies may be suffering from the drought of investment. And so we need to kind of get to a point where there's an equilibrium where things are more balanced. But look, if you want to raise money fast, put your tagline machine learning or supercomputer. You get money thrown at you, right? That's pretty much it.
And Kevin, last question to you. Also, what are your thoughts about the potential for 10xing early stage investments on the African continent?
Well, so first I'll say my thoughts are that A, it's possible, and B, we should want to do that, right? And let me get a bit philosophical here. Now, obviously, the issue is how long will that take? There's always a time component. But here's what I believe and why I think that working in tech is important. So I do believe in technology. I believe that underpinning every economic sector out there now, we live in a technological world, and we're going to be interacting with technology to do everything. Whether you'll do your banking, you'll get your food, you'll get your healthcare. Like technology is now what enables us to deliver goods and services faster, cheaper, better. Like I believe that, and so we can take issue with that. But if that's what you believe, and you've got a quarter or fifth of the world's population living in a space, you then have to want the technology that Africa is able to leverage and use. You're going to want that to be prevalent, robust, good, etc. And one of the ways to do that is, early stage investing. So, is how you help grow tech companies. They don't just pop up out of nowhere, right? It's a model. There are other ways that you can grow a company, but there's an investment arm of it, right? Someone has a concept, an idea, and a skill set, and they need capital to start that business. And the reason the whole asset class exists, whether that's PE or VC, and PE is slightly different, it's an asset, it's a capital allocation model that doesn't work for, say, a bank, right? Just to put that out there for everyone. So I'm a big believer that Africa does need an early stage investment market that's 10 times what it is now. And that's because, like, if you think about it, and again, not to get wonky, Thomas, when we spoke earlier, I did a lot of this in my like thesis back in the day. There are a lot of things that make up an ecosystem, a lot of interconnecting blocks, right? And there's the whole supply of talent, whether that comes from, university or out of like MNCs, multinational corporations, whatever. You need to have this culture, and role models. You need to have all these different things. So the regulatory framework. One of the things you need for a vibrant tech ecosystem is risk capital, right? You need early stage funding and advisors. You need growth capital. So to answer the question, I think the question was how do we get to 10x in early stage investing? I'm going to say we have to hit on all those things. So the culture, I think we need to continue to work on a culture of business creation and business ownership and business selling, right? The exits. And one of the reasons why I don't personally like hype in the ecosystem, hype is great because it attracts eyeballs, but hype is not great when it leads to the behaviors that we talked about in 2021. It leads to founders coming to me for, pre-everything, pre-website, wanting 10 million out of $50 million valuation, right? Because if you start there, where are you going to exit? So it's just understanding of we all have to, both investors and founders, that if we don't have an IPO exit market here in Africa, so trade sales, strategic sales, building good businesses and exiting them for outcomes that honestly, the day before you read it online, you would have been happy to exit for, but all of a sudden you go read about some Silicon Valley outcome, and then all of a sudden you want a Silicon Valley model. That doesn't help our ecosystem, right? It just doesn't. So to 10x what we're doing today, we're going to need more capital coming in from African sources and external. It means that we have to focus on the fundamental thing, right? This whole ecosystem exists to build good businesses. So we have to build good businesses, which comes from good business practice, good ethics, all this stuff is all combined. I could go on at length and we don't have the time, but the only way you're going to get to 10 times where we are today we're at what? So 2 years ago, we were at what? 4 billion or 5 billion. So you're talking of 40, 50 billion in early stage investment. Some of that was growth capital. You're going to need more talent, better outcomes, better governance, because why governance is important is when you have a war story or a scandal, it hits right at the heart of confidence, right? And investors are confidence animals. When I'm confident, I deploy. When I'm not confident, I hold on to my money. We all are. So all those things. You're going to need the support from regulatory stuff. It has to be easy to set up and exit businesses and fail businesses without overly punitive outcomes and so on. We need all of that. I could go on at length, but let me stop right there. 10xing is the goal, or should be one of the goals, and hopefully that's where we get to.
Thanks, Kevin. And that also brings us actually to the end of today's session. I learned a lot, and I hope the audience did the same. Just a quick recap. We not only need the GPs to broaden their LP basis. Tech founders also need to put their ego on the side, all to 10x early stage investing on the continent. Unlocking more capital locally is definitely something we need to do together as an ecosystem. And just in general, 10xing early stage investing in Africa is possible, but we need to do it together. As the verb goes, if you want to go far, or
go together.
If you want to go fast, go alone. If you want to go far, go together. So let's continue the conversation, because the conversations like this you can't read in textbooks. It's really just by having the wonderful experts in the room, as today, with these years of experience that Kevin and Sewu-Steve have in the early stage investment scene. So not only are we celebrating 10 years of ACES this year, we are actually also celebrating 10 years of angel investing of Sewu-Steve this year. So we need to bring some extra cake for you in Cape Town, boss. But that said, it's hard for me to drop a microphone now, but I want to thank you again for a wonderful session. I hope to see all of you in Cape Town. But not only that, we have more in store, and that's where I would like to invite my dear colleague Jeff on the stage. Hi, Jeff.
Hello, everyone. Great session.
Over to you to close today's session and tell us a little bit more about the plans for the coming weeks and months.
Hello, everyone. I hope you enjoyed today's session. I found it personally very interesting and very engaging. So as mentioned on the call during the session, portfolio management and exit is becoming a new reality on the continent. So in line with this, ACES have partnered up with the Zytec Investment Office to bring to all of us a masterclass on August 28, 2023 on portfolio management and exit. So come and join us and learn how you can manage your early stage investment portfolio towards exit via the Zytec platform. As long as with that, we're going to have our international investor meetups coming up on the 7th of September and our 50 African investor meetups coming up on October 5th. To find out more information about our investor meetups, kindly visit the Africa Early Stage Investor Summit.com And the main summit, as already mentioned, is coming up between November 30th to December 1st. So this is, as we have mentioned, our 10th anniversary, and it's going to be in Cape Town. We're looking forward to seeing you and joining us there. So for partnerships, contact Natalie Miller, Head of Partnerships at ACES, at natalie@africainvestorsummit.com. For investor meetups, contact Phil Okorafo, Head of Events, at phil.africainvestorsummit.com. And once again, thank you all for tuning in, and do have a great evening. Thank you and have a good day. Bye-bye.